Welcome to Industry Focus, the podcast that dives into a different sector of the stock market every day. Today's Thursday, January 10th, and we're discussing energy and industrials. I'm your host, Nick Sciple, and today I'm joined by Motley contributor Jason Hall via Skype. How's it going, Jason?
Happy New Year. I think it's still early enough in January I can get away with saying that, so I'm going to say it. Happy New Year.
Yeah, Happy New Year. This is our first new taping of the year. You know, last week we used our pre-record from back in October 4th, where we kind of looked ahead to what was going on in 2019. Some of those predictions have panned out, some of them not quite so much. So, the first half of the show today, we're going to, lay down maybe where we went wrong and kind of pull the thread on why that might have occurred. And then on the back half of the show, some of our listeners sent in some questions about different topics they wanted us to hit when it comes to 2019 energy trends. So we're going to hit that on the back half of the show. But first off, Jason, we could have picked better timing when it came to the oil market to tape our last show that we recorded last week, and you can find that in our podcast feed if you want to go back and listen to that. So we recorded our 2019 roundtable with Jason, Tyler Crow, and Matt DeLallo on October 4th, and lo and behold, that was the top of the oil market for 2018. Jason,
October 3rd and October 4th were the 2 days that West Texas Intermediate, the big benchmark for U.S. Crude oil, and then Brent crude on the day that we recorded that they peaked for the year. And since then, I think we're looking at a 40% decline. So, I mean, sure, there are macroeconomic things and there are major geopolitical issues, but I'm pretty sure that the four of us killed the oil rally. I'm convinced that it was us.
Hey, that's no doubt about that, Jason. They say, are we signal or noise? I think we might be signal over here, but don't want to build us up too much there. But yeah, you're right.
Somebody call Nate Silver.
Right, exactly. But yeah, right. Both Brent and WTI back in October were up, above 20% for the year, and actually turned out that crude oil was among the asset classes available was the worst performer last year, down for the year 24.8%. So that's a significant swoon to have gone from up 20-30% on the year back in October to really collapse. And there were a few things that kind of contributed to that. First off, when we recorded that show back in October, Matt had mentioned what kind of impact Iran sanctions might have on the oil markets, and it really didn't turn out to have much of an impact at all when it came to reducing supply. I want to say around 97% of Iran's exports, at least from 2017, the nations that they exported to, were exempt from Iran sanctions. So essentially, that oil supply never came off the market. And then in conjunction with that, in anticipation of that supply coming off the market, Saudi Arabia had increased their production. So we kind of got ourselves in an oversupply situation, back in the back half of the year. Is that consistent with what you saw, Jason?
I think so. I think there's a really good learning opportunity coming out of that when it comes to, and it's not even just oil and crude oil that we can use this for. I mean, it carries over to iron, just about any other kind of raw good, any type of commodity that's produced on an international basis and has lots of things that affect it. And the lesson is, if you look back then, you think about it, you talk about the Iran thing. I think so. The big drivers that had pushed oil up to that point was the expectation that with all of the problems that we've talked about multiple times on the show, with geopolitical problems in countries that have killed oil production in a lot of places, and then with the Iran sanctions, there was this major expectation that there was going to be, the oil market was really going to get tight. And especially considering coming out of the U.S., President Trump has been so hard on Iran, right? I mean, he was coming down really hard, with these sanctions. And there was that expectation that, okay, all right, so the Saudis are going to have to bridge the gap a little bit. It's going to take them a little bit of time to do it. And I think the other thing that maybe some of us missed that we should have considered, and it's hard to because there's always something in hindsight that you see, right? But at the same time, the Trump administration has been very hard on pushing oil prices down, right? The impact on economic growth. And, Trump has said repeatedly when oil prices were peaking that oil prices needed to come down. And, I don't know that there was necessarily any particular, we did it on purpose. I think there was probably some pressure from some of our allies, some of our trading partners, to pass those exemptions. for Iran's oil. But the net result was, this thing that nobody was really seeing in the tea leaves. We ended up with a lot more oil than we thought, and here we are today. So yeah, that's these things happen. And the point is, I guess the big lesson is you can't. It's so hard in the short term to predict what's going to happen because there are so many levers and so many things that influence commodity prices that you just can't predict, and you have no control over and no way to know what they're going to do. And that's where the risk lives, right? It lives in what you don't know. So here we are.
Exactly. I mean, I think like you said it perfectly. When it comes to these global commodity markets, there are just an innumerable number of variables that can impact the price on any given day or any given month or any given year. And so to try to predict that is just a very dangerous game to play because you're always going to get surprised coming around the corner.
Absolutely.
Talk about some kind of geopolitical events that are still continuing to play out. Venezuela's production is still continuing to fall, so that's going to continue to affect markets. That's kind of a thing we pulled the thread on a little bit back in October. I think there's been some issues as well in Libya with some folks shutting, militias and things of that nature, kind of shutting down some major oil fields there. So those are things affecting the market. It'll be interesting to see, how things continue to play out, geopolitically there. But the oil markets have rallied a bit to start the year, but it's just very difficult to predict. And as Jason mentioned, for investors, you don't want the key of your thesis to hinge on predicting what's going to happen in these global commodity markets, because that's very, very difficult to predict, and it's a dangerous game to play.
Absolutely.
Another trend we kind of talked about, and we are starting to see play out a little bit, was just what kind of role LNG is going to play, going forward. And just this past week, we heard reports out of the Wall Street Journal that Saudi Arabia is looking to make potentially significant investment in U.S. LNG exporting facilities. What's your takeaway when it comes to those rumors and kind of looking at LNG going forward this year?
So liquefied natural gas is really, I've been relatively bullish on it for a few years now because for the U.S., we have this massive glut, and it's not just in natural gas fields. It's also this associated gas, which you think about the Permian and the huge growth in oil production in that area. There's a lot of natural gas that just kind of comes up along with the oil, and capturing that and maximizing the economic value of that gas has been a challenge, but the technology's gotten better. There's some regulatory pressures to do that too. So anyway, we have this ton of gas, and really it's more than the U.S. is able to consume internally. And historically, gas has been relatively geographically used, but LNG is kind of changing that to be able to export it across oceans, to be able to use it for petrochemical manufacturing. But I think especially for energy production, as a challenge to coal, it's cheaper. You think about countries like China that still have a really rapidly growing economy, that have a burgeoning middle class that's wanting to consume more energy, that has a lot of internal problems with pollution from coal production growth over the years. There's just going to be pent-up demand for gas for a long time. I think when you look at Saudi Arabia, they've actually used crude oil distillates to produce a lot of their internal energy. So I think one of the things they're looking at is being able to utilize natural gas imported from other places for their internal electricity production, so that they can monetize their super duper cheap oil production a little bit more effectively. So I think that's kind of part of their game. And I think it makes sense, and it gives them a little bit of diversity too, away from just this crude oil, which is still such a it's their economy still. So yeah, I think we're going to hear more noise about this as time goes. It makes a lot of sense.
Yeah, exactly right. The Saudis have really wanted to diversify away from oil, to kind of just get their economy less dependent on that one single resource, for their production. We've seen, the Qatar is going all in on gas production, even to the point of leaving OPEC to kind of go after that. So it's, we're definitely seeing some signs that it's a trend that it's going to continue to play out. You mentioned coal. And kind of where coal's starting to sit relative to other energy resources, and it kind of plays a role in what's going on with renewables. So I saw another article in the Wall Street Journal, just came out today, I believe, speaking about how a lot of utilities in the United States have sped up the pace at which they're going to retire their coal plants, just because of how cheap solar and wind have become on a per megawatt hour basis relative to coal. So, we're seeing these trends from LNG, that a little bit cleaner burning fuel, particularly, exporting overseas, is that's a cheaper alternative. But even domestically, we're seeing these renewables displace coal as a bigger measure of our production. I think Xcel Energy was the first utility to come out and say that, hey, we're going to be 100% carbon free in energy production. I think they put 2050 as their target for that. So, I mean, we're really starting to see a push away from these legacy energy producers like coal, and really LNG and renewables come to the fore as, the energy production of the future.
Yeah, and I think that's going to remain the case. One of the interesting things that's happened in the U.S. that's driven natural gas prices down is the advent of fracking, hydraulic fracturing, and being able to tap these shale natural gas resources where there's this huge glut. But at the same time, there have been constant advances in solar technology that have driven down the cost per watt of producing a solar panel, have pushed up the efficiency of the panels to be able to capture more energy per unit of actual panel that's installed. And we've seen some of the same efficiency gains, if not quite as much, but we've seen a good number of efficiency gains in wind turbines too. And the bottom line is, especially with wind turbines right now, they're competitive with just about any other way of producing electricity in the U.S., competitive even with natural gas. And obviously there are some tax incentives that play a role in that, and those are gradually rolling off for the production side on wind. But even as those roll off, just the scale of the industry driving down costs and the improvements in the efficiency of the turbines is getting to the point where it's just cheaper, right? And if it's cheaper and it's also a carbon neutral way to do it, it's just kind of where we are.
Right, Jason. And I mean, we mentioned how difficult it is to predict oil prices and the volatility there, which has led me, at least personally, and I think we've discussed this over Slack a little bit, to just kind of lump a lot of these oil-related names or oil-related businesses in kind of the too hard pile. We don't know what's going to happen when it comes to volatility and what's going to move in these global commodities. But I think if you look out, 10, 15 years, what I can know for certain is going to get bigger is solar and wind energy production. We're seeing them become more cost parity with other production alternatives. And then, as we mentioned, on the previous show, when it came to the duck curve, right, the sun isn't always out and wind isn't always blowing. So there's going to be a need for something to come into the market to kind of fill in that gap when those things aren't working. So that's going to be battery storage technology over the long term, and it's going to be LNG peaker plants to come in and fill in that demand when energy demand comes online. So the places that I'm going to be looking for ideas, in energy, right now are going to be areas in that space. So how are we going to bring LNG to market? How are we going to export it? What is in the value chain for these batteries that we're going to use for energy storage? And then what's going on, in all the different facets of wind and renewable, energy like solar? What are your thoughts on that kind of idea, Jason?
Well, I think you're pretty spot on, with the caveat that here in the U.S., because we're producing the gas here, it won't even have to be liquefied natural gas, right? Because we have a huge pipeline infrastructure that already exists. So the U.S. is going to be able to use natural gas coming right out of the oil fields and then going right into the pipeline, so it's even cheaper. But certainly in Europe and Asia, LNG is going to be a major source of energy. Supplanting coal, and also nuclear too, right? We haven't really mentioned that, but nuclear is a lot of the plants are getting super old and they're kind of aging out, and they're not being replaced with new nuclear plants. And it's going to be liquefied natural gas kind of for that base load, and then for some of the peaker demand, and then renewables and battery storage to help with it as well. I think so. But I think you're spot on too about the difficulty in predicting oil and gas prices. I did a little bit of research, and one of the things that I looked at before the show is I looked at the S&P Oil and Gas Explorer and Producers Index going back to 2016, early 2016. So this is the companies that they're pure plays in oil and gas production. I mean, these are U.S. companies mainly. So you go back to February of 2016, which is oil prices basically bottomed, right? We're looking at, oil was trading in the high 20s, low 30s. And since then, oil prices have, even after the decline since October, oil prices are still, up like, 60% from then. They're up substantially. But that index is only up about 14% in total returns. As a comparison, the S&P 500 is up about 42% since then. So that sector, even from the lowest oil prices that we've seen in 20 years, 16 years, has vastly underperformed the rest of the market. So I agree completely. I'm just these pure play oil and gas producers. I definitely put them in the too hard bucket because they tend to follow oil prices. Even the low cost guys, even the ones that have the strongest balance sheets and have the ability to reinvest their cash flows and live within their means and not have to take on more debt to fund, capital expenditures and that kind of stuff. They follow oil prices. You can't predict oil prices. I just think most investors would do better off investing somewhere where there's just more predictability, right? I think that's the key thing, right?
Yeah, it's not to say there's not money to be made with these E&P players or folks tied to oil prices. It's just you have to pay a heck of a lot more attention, and you probably need a little bit of luck to get in and out, when prices are favorable. So if you take a long-term view of what I know is going to happen, I think that there are better, alternatives elsewhere in the market.
There are easier alternatives to get an acceptable rate of return. That's the thing, right? So I think people go into these E&Ps a lot of time looking to try and get that big quick double because oil prices are going to go up, and then something nobody expects happens, and you end up losing 25% or 30% before you know it. So that's the thing, right? If you can just focus on capturing an acceptable rate of return and something that's a little easier to predict, you can avoid these unexpected losses.
Yes, it's something to watch or keep in mind for investors when you're making decisions on what you want to buy and sell. Okay, Jason, let's take some questions from our listeners that we got via Twitter. Just a reminder to our listeners, if you want to send us in any questions, you can reach us on Twitter at MF Industry Focus or via email at industryfocus@fool.com. First question we've got is from Cam Kane on Twitter, and he says he'd like a show on the American yieldcos. Terraform Power, Pattern Energy, NextEra Energy, and Brookfield Renewable. What's in store for them in 2019, and what are the pros and cons of each? You'd also like us to dive a little bit into wind with Vestas. So, of course, this is going to need an entire show for us to dive into all these issues. But on some of these names or companies that he mentioned, number one, what's your favorite out of this group? And number two, is there anything in particular you want to call out about these companies? Knowing that we're probably going to dive into these in a more deeper fashion here later on in a few weeks.
Well, I jokingly replied on Twitter and told him just to buy them all. And I'm only kind of joking because in general, I am bullish on this entire sector. I think there's a really predictable path for them to grow. I think because this is the sector of renewables where you see consistent cash flows because they sell power on long-term contracts. I do like the space. But I think looking at 2019 from where we are today, I'll say Terraform Power and Brookfield Renewables, which owns about 2/3 of Terraform Power, they're definitely at the top of my list. They pay really high yields right now because the market's been relatively down on them. But that entire Brookfield asset management kind of umbrella of companies, they're just really good at making money. They're really good at investing in assets that provide really good returns. And I think that pattern of doing that, their history is going to prove out over the long term. And right now, Terraform and Brookfield Renewable, they both look like great values. They pay super high yields, and their ability to grow the payout over time, I think, is going to prove to be well above average.
Yeah, Jason, calling back to what you mentioned earlier, I think these yieldcos kind of fall in that perfect bucket of a reasonable return relative to the risk that you're taking into the investment. In particular, these Brookfield affiliated businesses, they just have a long track record of successful, profitable investing. And, as we mentioned on the first half of the show, there are some, significant signs of growth in these areas that are going to need more infrastructure investment. And that's what they do. And they do it profitably.
Yep, absolutely.
All right, our next question, Jason, is from S. Johning on Twitter. If I say your name wrong, I apologize. It's kind of a two-parter. The first one, he wanted us to talk a little bit about what's going on in drone development applications in, industrial and crops and weather gathering areas. We have seen, drones have had some applications, industrially. I know Avita Systems is a subsidiary of GE, and they use drones for inspecting industrial spaces. They even use them for underwater inspections. And then, we're also starting to see some drones in the agriculture space. It's just cheaper to have a little robot fly over your one field than to pay some guy to come fly, go fly, a plane over your crops. It's a little bit more cost effective alternative. For what I've seen, there's not a lot of, drone specific plays available on the market. AeroVironment is one. They make some military drones that have moved to some commercial space. What are your thoughts on drones just as an investment opportunity, Jason? And are there any companies that you think are interesting in the area?
Yeah, I think there's the big challenge. You kind of hit it on the head, is that you think about Avita's part of GE. And you think about some of the big kind of defense mega conglomerates that have parts of their business that do drone work. These are typically a small part of a much larger business, and I don't know that the drone business for those companies is necessarily meaningful enough that you would want to build a thesis around investing in that company just because of it. But I think it might be worthwhile at some point later this year that we did invest a little more time and really kind of dig in a little bit more to kind of talk a little bit about the specifics of that. But I do I will say this, I like AeroVironment. I do. I think it's been kind of a tough past few years. But the past year, I know the stock's up pretty good. And but in terms of pure plays, yeah, I think AeroVironment's really about it. But it has a ton of competition from some really big, really well capitalized companies that do a lot of other things. So yeah, I think we should really just kind of punt and maybe talk a little bit more about it with a little more dedicated time.
Yeah, there's just not a lot of investable opportunities out there right now. I think, as I mentioned, I think AeroVironment's one of the only ones available in the market. So I think drones are definitely going to be an interesting thing to watch going forward. They have a lot of applications, all across, different use cases. But for right now, from an investment perspective, we're just really limited in what we can choose from. But it's definitely something to dig into later on. As Johnny also asked about, are we seeing any moves to, use solar in more kind of targeted environments? So I think he mentions one where you could have your AC powered by a specific solar panel and different things linked up that way. Do you have any thoughts on this? I know as prices come down, the ability to use solar for many more applications, of course, is going to open up over time. But what kind of developments are you seeing here, if any?
I think for the most part, not really, especially for these kind of stationary uses. Just because really the power of solar is in scale, right? The more you're able to deploy, the more efficient it is, the more power you capture, the lower the cost per unit of energy produced is, the cost per watt. So I think that's one of the challenges. But I think, maybe in certain areas where you look at remote power, you think about maybe a military application for getting really remote, a backpacker that's looking to have some source of power while they're getting into the backcountry. You'll see, the efficiency gains are going to help kind of make the technology better there. But I think in general, yeah, you will. But I don't think it's kind of like drones. There's going to be a little bit of a commoditization happening there. And there's going to be a few small specialists that maybe they make one or two little things that catch the eye of a certain kind of vertical market. But I think in general for stationary applications, especially in urban environments and grid connected environments, there's not necessarily going to be a ton of value for these specific application stuff like powering a window unit kind of thing.
Yeah, I think probably in the near term we're going to stick with those old solar powered calculators. But as we get more efficiency over time, hopefully we can get to where everything has one of those little things up in the top corner and it'll run everything. But the technology maybe is not quite there yet, but it's definitely an exciting opportunity looking forward. All right, then our next question comes from Warren Kiesel on Twitter. He's a big fan and enjoys the show. He wants us to discuss Kinder Morgan and its prospects for the coming year. Says the stock has been a dog, but is the company in good condition? Jason,
where is Tyler Crow when you need him?
Yeah.
So for the uninitiated, Tyler Crow, one of our fellow writers, is not a fan of Kinder Morgan. On the other hand, Matt DeLallo, another one of our really top energy contributors as well, he's a big fan of Kinder Morgan. I know he owns a pretty substantial amount of it. So, he definitely has the skin of the game behind whenever he writes and talks relatively positively about it. So I think if we go back, let's go back a little ways, right? If we look at Kinder Morgan from the time that it went public to now, I think the stock's lost about half of its value. I mean, it has not been a good investment. Even we add dividends in, it's still down like 28%. And a lot of that goes back to the oil crash from 2014 to early 2016 when oil prices fell, like 70%. There was just kind of a freeze in investment in the area, and the company had to halt its dividend like 2 months after saying that they could continue to pay the dividend. They just stopped it because their creditors said, you got to clean up your balance sheet and you need to have more cash flows, or we're not going to extend you any more money to fund these projects that you're talking about. And that just cratered the stock price, right? I mean, it really did. And the company has the stock price has slowly recovered. And, if you look back, since the oil price bottom, Kinder Morgan stocks generated about 24% in total returns, which, that's not too bad for a couple years. So that's good, right? The past year hasn't been great. But, some of the things that Matt talks about that are important is, the company has spent the past, year and a half, 2 years kind of deleveraging, signing more kind of joint partnerships for development of projects instead of going on its own on these massive big projects. It sold off its a big pipeline in Canada that it's Canadian. Yeah, the Trans Mountain Pipeline that its Canadian subsidiary held. So, it's really been still kind of getting its house in order, but the dividend's up like 60% over the past year when they reinstated it. I think they're going to increase it another 25% each of the next 2 years. So, I think if you kind of take everything that's happened in the past and kind of park it in its own little place, and you look at the go forward picture, it looks good, right? It looks like Kinder Morgan should be a predictable, high. It's going to be yielding, I think, based on the dividend increase later this year, it's yielding like 6.5%, 7%. So again, on a forward yield. So so there are definitely things to like about it. But what I always go back to, and the reason that I sold and no longer hold any shares, and I don't want to speak for Tyler, but in past conversations, he's kind of intimated the same thing, is that this is a company that has tended to get more aggressive over time, take on more leverage, take on more risk. So if I were to invest in it again, and I don't think I will, but if I were an investor, I would watch really, really closely how management acts in terms of adding additional leverage over time. And if it starts to lever up and add more debt, I would probably move on relatively quickly because, again, it gets back to the unpredictability of the oil markets and how that can affect a company that might be investing in a future project, and then the bottom falls out of the oil market and it has problem capitalizing that major investment that it's made. So I would just kind of put it in that box, or that penalty box, and watch it really closely. And if the balance sheet starts to get a little bit levered and starts to squeeze on cash flows, then I would probably move on pretty quickly.
Yeah, Jason, it's definitely a management question because when you look at, I saw the stats there. They move about 40% of all the natural gas consumed in the U.S. They're really tied to the whole natural gas growth story, which we kind of laid out in the front half of the show. They're investing in an LNG export facility, I believe, in Georgia. So if they can, management can avoid taking excessive risk, they do look like they have some opportunities in natural gas, but, their track record has not inspired confidence that's going to be the way that plays out. And, you got to ride the cycles with these businesses. So that's kind of an important factor to watch.
Yeah, absolutely. I think another good thing right now, just kind of another bullish signal, is even with this dividend increase that's coming up, the company's only going to pay out about half of its cash flows this year. to cover the dividend. So that's a substantial amount of cash it's retaining. And that's something it has not done in the past. So that's definitely a good signal. But again, watch it closely.
Sure. Okay, Jason. And then our last question's from me. Back in October, you picked Terraform Power as your kind of safe pick for 2019 and SunPower as kind of a high upside pick. There's still your picks today, or is there anything else that's kind of on your radar that you want to tell folks about?
No, I think it still is, with the one caveat that is, as I mentioned earlier when we were talking about the yieldcos, I would wrap Brookfield Renewable in with Terraform Power, just because the market has given up so much on it and it's pushed the yield up and it's created a really solid value. And the reason why is the company has spent the past year and a half or so, management has at one point had sold off substantially more dollar value in assets than it had acquired. And it's just taken it time to kind of recycle that capital into new projects, into new assets. But the key is that it's sold these old assets that were growing at like 2-3% a year and at a lower cash flow yield. And it's reinvested that capital, and it's working on closing a few of those deals and projects that are going to generate like mid-single digit to high single digit yields. And they have like double to triple the organic growth potential. So it's going to take time, but the market's given us a great opportunity, selling the stock off like 15% over the past year, to buy these higher yield assets at a lower price and get rewarded with growth in the coming years.
Yeah, great thesis, Jason. I mentioned earlier in the show, and stuff I think we're going to continue covering going forward is what investors really need to watch is natural gas, renewables, storage. I think storage are probably the most important things to watch. We're going to continue covering this year. I think Terraform Power covers that. It covers that in a significant way. And that Brookfield connection, as I mentioned earlier, you just know that they're going to make money no matter what the cycle does. And when you're seeing an inflection point in the pricing, it seems to be a compelling position for somebody like Brookfield to come in and start making some investments and starting to profit off of where the market's going. So I definitely think that's a company to watch, and probably could fit into a lot of investors' portfolio.
Absolutely.
All right, folks. So next Tuesday, I'll be back. I'll be discussing casino stocks with Asit Sharma on consumer goods. And then also next Thursday, we'll be discussing the latest news in the auto industry. If anybody has questions about that, you can reach out to us, as I mentioned, on Twitter at MF Industry Focus or via email at industryfocus@fool.com. Looking forward to talking to you again soon. Thanks for coming on, Jason. Always fun to talk to you about what's going on in these energy markets. And I know we'll have you on soon to break everything down.
Sounds great. I'm always game to come on.
Yeah. As always, people on the program may own companies discussed on the show, and the Motley Fool may have formal recommendations for or against the stocks discussed. So don't buy or sell anything based solely on what you hear. Thanks to Austin Morgan for his work behind the glass. For Jason Hall, I'm Nick Sciple. Thanks for listening, and Fool on. All right, Jason, we actually did have one more question. Our resident Motley Fool, Fool.com tech expert, Brian Ty, had to ask us about what happened in the national championship game on Monday night. The last time I had you on the show in December, we kind of previewed what was going on in the college football playoff. And I figured we would come back and revisit what happened for folks who didn't see. The Alabama Crimson Tide were pretty well throttled by Clemson. I believe the final score was 44-16, a 28-point victory. What'd you see out there, Jason?
Yeah, so so if you go back to the last time you and I chatted before, I did say that, I thought that the gap, the talent, the gap between Clemson and Alabama was probably a lot narrower than a lot of prognosticators were expecting that it would be. Coming into that game, there was a lot of talk about, this being the best Alabama team ever, right? Like a historically great, and it was a historically great team, especially on offense, but still a very talented defensive team, especially on that line. So anyway, and I said, if Clemson can get pressure and containment on Tua Tagovailoa, the Alabama quarterback, that it would have a really good shot in the game. And while I was partly right, they got a little pressure on Tua. What I was completely didn't expect was how good that freshman quarterback looked. By the way, he grew up about 45 minutes from where I did, so I should have known about this guy. But what an incredible performance by that offense. And I mean, I was expecting Bama to win by 10 points. Talking about shocking the world. This was, wow, they beat the crap out of your Crimson Tide. They really did.
Yeah, I mean, what I thought going into the game, Jason, was that, we talked about how great Clemson's front was, and they're all incredible players. I thought if Alabama could run the ball, they would have a really good chance to win, that they would open up, they wouldn't be able to kind of keep a bunch of guys deep, and Tua would pick them apart. And Alabama was able to run the ball pretty effectively, but, Tua made a few mistakes. That pick six early in the game really hurt him. And then, they really just stalled a lot, in the red zone many times during the game. There was some questioning what happened with the fake field goal at the end of the game. Anyway, in the second half. But I think the real story of the game was that, Alabama's defensive front was pretty well stymied by Clemson. They had no sacks the entire game. And then Clemson really dominated on third down. I think they had 3 or 4 third down plays that were 20 yards or more. And, the big thing is too, you mentioned how close together these teams are when it comes to talent. And if you're a team like Alabama, who is more often than not going to, have a big talent advantage versus your competition, when you play a team like Clemson and you make mistakes, they're going to punish you for them. And we saw that, the cornerback fell down on one play and they took it to the house. That was just the story of the game. When Clemson needed to make plays on third down, they did. And when Alabama needed to make plays, they didn't. But all that to say, I think Alabama will be back strong again next year. Nick Saban likes to focus on the process, doing what you have to do to improve and get better every day, and not to focus on your results. I think that's a good way that investors should probably try to look at their own portfolios, and that you're gonna get your lumps every now and again. Some unexpected things are going to happen that makes parts of your portfolio tank. But if you can just focus on the process of getting better every day over time, and focus on the long term, what you need to do to achieve your goals, you'll sooner or later you will be rewarded.
I think for us mortals, that's really, really good advice. My question though is it possible that Nick Saban has just run out of souls to sell? That's a possibility. I mean, I think you have to consider it.
Maybe you can, maybe you can. I just think he's the hardest working man in the game, and yeah. But we'll see. It was a great season, and it wasn't a totally bad week for Alabama Crimson Tide football folks. You had Freddie Kitchens, former quarterback for the Tide, named the head coach at the Browns. You had Bruce Arians, former Alabama offensive coordinator, now the head coach in Tampa. And then let's not forget Dabo Swinney was part of the 1992 Alabama national championship team when he played there, and has only really coached 2 places, at Alabama and Clemson. So, it was a tough game, but, if we just focus on the long term, Bama will be back, and there's always positives to come out of situations like this. So for folks to remember, whether it's in sports or investing. That's right. I'm gonna make a prediction. Here's the way too early prediction. Georgia and Alabama will both play they'll play in the SEC championship game again next year. I think Georgia will be undefeated. Alabama will have 1 loss. They will have lost to LSU, but it'll be in Alabama, in Tuscaloosa, because I think it's a home game for Alabama next year. Georgia will make the playoff, and Alabama will not. So that's my way too early prediction for next season. All right, Austin, I want you to clip that, and we'll come back to it this time next year. Write this down. All right, Jason, I really enjoyed having you on. Good to wrap up the college football season. I'm sure next season we'll talk about it some more. We'll have a little break, for a month until National Signing Day, and then always more news. I hope our listeners enjoyed this little discussion, and we'll see you again soon. Pitchers and catchers report in 2 months, folks. There you go. Roll Tide.